Meanwhile, oil prices are rebounding today after closing short of $70 a barrel on Wednesday. Today, it's a weak dollar, pushing crude back over $70 a barrel, outweighing yesterday's report of a smaller than expected drop in crude supplies. Meantime, natural gas has been getting a boost from speculation of an increase in demand on the horizon. It's now hovering near $5 per thousand cubic feet. Here with some insight into oil and gas is Elliott Gue of the Energy Strategist and the Energy Letter. Hi, Elliott.
Morning.
So it does look like oil back up over 70. Is it the weak dollar that is mostly at play here?
On a day-to-day basis, that can certainly have an effect. We have seen generally, there's generally a belief that the global economy is recovering a little bit, and that's supporting oil demand as well. That's the other factor.
Now, so the stocks of crude and other petroleum products are coming close to records. How is the demand picture for oil as you see it?
What we're seeing in the U.S. is year over year a little bit of an uptick or at least a stabilization in demand. Outside the United States, particularly in the developing world, that's where most of the recovery has come from.
Gasoline stocks jumped nearly 3 million barrels, a lot more than predicted. How significant is that?
Well, we're getting sort of in the end of the season where people are starting to look from gasoline more towards the distillate side, more towards the heating oil side this time of year. Stocks of petroleum products in the U.S. are high overall if you look at crude, distillates, or gasoline. But they've been generally, over the last several months, moving lower. So it's moving in the right direction, but they're still high.
I want to move on to natural gas, but I just want to get your opinion on this story today about Saudi Arabia silently calling for financial help. It wants to be one of the needy countries under climate legislation if there are moves toward moving away from oil. Saudi Arabia, the IEA says OPEC revenues would still rise $23 trillion over the next about 20 years, even if countries cut emissions and move away from their dependence on oil. Saudi Arabia says it would lose $19 billion a year. Do you have any idea who's right there?
Well, my sense is that a lot of the climate change talk that's going on right now is really focused more on the electric power market, and the use of coal, which is of course the dirtiest fuel in terms of CO2. Very few countries use oil in any meaningful amount, to produce power.
So climate legislation would have to reach into the transportation sector to have a big impact here?
Absolutely, and I think that might happen, but it's going to be years in the future. So I would think in the short term, you're still going to see most of these countries relying very heavy. I think something like 97% of U.S. transportation demand is met by crude oil, or gasoline. So it's going to take a lot longer to move passenger cars off of crude oil basically than it would to say switch in the power sector more away from coal towards other types of fuels or towards cleaner coal. So I think that's something that might be a concern for them years in the future. The other thing is look at where all the growth in demand for oil is coming from. It's not coming from your developed countries. It's not coming from the United States. It's not coming from Europe. It's coming from China. It's going to be almost impossible for them to change that pattern in the short term. So my feeling is that you're going to see actually quite high oil prices. The only way that we're going to produce more oil in the world to meet all this demand is to go after these much more difficult to produce reserves. 3 or 4 weeks ago we had that announcement of the Tiber oil field in the Gulf of Mexico. It's a 35,000 foot plus well. I mean, it's difficult, expensive to drill. You need high oil prices.
And now a new find off of the west coast of Africa.
Absolutely, which is the Anadarko find. And again, that's not quite as deep water, but it's still a very complex well. If you look at the kind of wells they're drilling today versus what was even thought technically possible 10 years ago, it's pretty amazing. But those are expensive. Those are going to require $70 oil for those companies to feel confident to go out and invest in a project. BP's Thunder Horse project in the Gulf of Mexico was delayed several times. Took almost a decade to bring on stream. So, companies that are looking to produce oil out of these finds have to think 10 years ahead of time.
So there will be oil, there will be increased demand for oil, that's going nowhere, and the price will be higher.
I think that all of that's going to be true because what we're seeing the oil price do right now is it's trending up to the level which allows marginal supplies to come on the market. These deep water fields, oil sands, that sort of thing. You need oil prices up around $70 or $80 for those companies to really spend the money to invest and increase production from those fields.
Well, Pickens says we're going to be there by the end of the year, so I guess we'll see. Natural gas inventory report out today, 10:30. The last one showed a record. Are you expecting another build?
Yes. I mean, we're going to see at least 3 or 4 more builds in the natural gas market, I would imagine, until we get into early November, when we start to get that heating demand coming back in. We are going to reach a record. A lot of these companies have been saying for months that we would actually reach physical storage capacity. There's some evidence that over the last few weeks that some of the reason you've seen the builds be a little bit less than expected is that you're having a lot of the pipeline companies basically telling companies not to send more gas across the pipeline, sort of controlling the flow of gas. We may already be reaching a shut-in condition in parts of the United States. In fact, we almost certainly are in the producing region.
Right. So what is the latest with this storage capacity being reached situation? Because a lot of people that are coming on our shows are saying, well, we can't really tell because so many companies can compress more gas into the ground, so there's not an issue of reaching capacity right now.
There's no way to know exactly what. Obviously, there's some level at which you could put no more natural gas in storage, but nobody really knows what that level is. There's just estimates because yes, you can compress more gas. You can compress gas a little bit more in pipelines, effectively storing gas in pipelines in a way. Nobody really knows exactly how much maximum storage capacity is, but it doesn't really matter whether we physically reach that absolute maximum. The point is that it's totally full, and that already you're having pipeline companies telling firms not to send more gas and basically shut in wells. So whether it reaches a level where it's physically about to burst, or if it just reaches a level where companies are saying, we can't accept any more gas for storage.
So these companies are pretty happy about predictions of a pretty cold winter coming.
That's one of the reasons you've seen the near month futures really pick up, or November and December, because people are starting to predict maybe that we will have a colder than average winter.
But what about a comeback for industrial demand? This is the bulk of demand, and that's why prices are near $5 right now. A speculation that that's about to increase because the heating oil situation isn't happening for another month or so, right?
Right. That's going to come in. The demand for winter heating is really something that affects the futures, say 2 months out. The industrial demand is heavily dependent upon the state of the economy, and in particular the state of the manufacturing industry. What's been causing speculation that that's beginning to turn around is a lot of the manufacturing numbers we've been getting over the last about 3 months, since about midsummer. We've seen the PMI numbers, the Purchasing Managers Index numbers. We've seen the industrial production figures really turn up pretty sharply off their lows. Now they're still at levels that are consistent with, at best, a stable manufacturing type situation, but they're certainly coming off those lows that we saw, those extreme lows we saw earlier this year.
And that's lifting all energy commodities, not just gas.
It's absolutely lifting all energy commodities. Gas has just been the most dramatic because it was the most depressed. The EIA numbers are also indicating actually that earlier this year industrial demand was down something like 15% year over year. The most recent natural gas monthly report, was released at the end of September, is showing it's down more like 10%. So it's definitely a slowing in the rate of decline.
So what do you think of Boone Pickens' prediction on $7 natural gas next year, $9 in 2011?
I think you will see $7 gas next year. Part of the reason is we are definitely seeing an acceleration in the production declines, and it's the lagged effect of all those rig count reductions that we saw. If you look at the state-by-state data, certain states are seeing an uptick in production. Louisiana produces less than 5 billion cubic feet a day of natural gas. Haynesville, which is in Louisiana, is very attractive, very economic, even at current gas prices. Therefore, you're seeing rigs go into Louisiana. But Texas production, which is over 20 billion cubic feet a day, the largest state, is declining rapidly because you have a lot of conventional wells still in Texas, which aren't profitable unless you get up over $6.
Wow. Okay, we'll keep watching that market. Elliott Gue, thank you for coming in.
Thanks for having me.
Always appreciate your insight.